Hey everybody, this is Jose. We are 10 seconds away from starting the session. Sound check, please. Please go ahead and confirm that you hear my voice. Very good. So it seems that sound is good. It seems that we are ready to begin. Therefore, let's get started. Good to see you all. I'm looking at the chat box. I see your names. Wonderful, wonderful everyone. Thank you so much for joining me on Sunday today. Today is 21st of July 2019. I said it very quickly. Let me say it one more time. My name is Jose Blasco. I will be your guide, and today we are getting together for sharpening purposes. Sharpening means that we're going to take our skills to the next level, little by little, taking advantage that the market is closed and we have time to do so. We're going to spend time in this session looking at our skills and just sharpening them. So that way, when we get together again during the weekdays and we do trading sessions, then we can be more and more efficient as we spend time together and we master how trading works and we master the markets. That's the plan. Before we start, as always, disclaimer. So I'll take care of that and we'll begin. Disclaimer. The following videos, clips, demonstrations are for educational and instructional purposes only. Tradictive provides these videos purely for the purpose of demonstrating a method of using the product. Users understand that all the content used in the video is purely for demonstration purposes only and is not a guide and does not provide any indication or prediction of actual results. As a user, you understand and agree that hypothetical results obtained through a demonstration do not indicate in any way the results you may receive on using our products. And that will take care of the disclaimer. So I'm bringing TradeStation, our beautiful TradeStation, up. We have the TradeStation, we have the UFOs, we have all our tools, and as well as always, when doing sharpening sessions, I often bring a blank page so we can start making certain notes and put a little bit of structure into the conversation that we're going to have today. So today's conversation, as you can see, it's about building and maintaining a portfolio. Again, the more time we spend together, the more excited I am, because if you compare months ago compared to what we do now and the structure that we have in the current times, we have certainly evolved, if it's okay for me to phrase it this way. There was some time ago where we would look at the trades, and we would have a limited set of rules to identify trading opportunities. Nowadays, when it comes to putting trades together, we have all the rules defined, both to plan the trade, also to execute and to maintain the trade. But the one thing that we never discussed, and today is going to be the first session, is what about running multiple trades at the same time? This is what we call portfolios. We also covered in prior sessions. We talked about the gammas, the deltas. We talked about that when you run a portfolio and you got multiple positions that are long, maybe it's healthy to add some short as well, etc., etc. And therefore, I think that the concept has been laid out in the past, where we understand what's a portfolio and the importance of planning for that portfolio to be in a certain form, and then of course to maintain it. But we never got to look at the how to do that. And when I mean how, obviously I'm talking about which is the set of rules that we're going to use to do that. Okay, and that is the plan for today. Okay, that is the plan for today, to define what do we need in a portfolio, and once we have it, as the market conditions change, because the markets are dynamic, isn't it? So how to readjust those portfolios to be properly exposed to the market and therefore end up in a safe situation without getting in trouble, and maximize the profits as we can, but also always minimize the risk at the same time as we position ourselves to maximize the profits. And also, one last comment I will make before I start typing in here is also, remember a long time ago we run a session on long-term trading. You may remember this. We talked about diversification being a concept that is often misunderstood. Many times when people think of diversification, they think of adding markets such as bonds and golds and metals and energies and things like that, all together with equities. And then most investors around the world, I'm talking about the retail investors, the ones that are not professionally educated, but most of those investors, they would feel, okay, I'm diversified, I'm fine. Well, we said that is not the case, that even markets that may not seem to be related, many times they react very heavily to what may happen to the equities markets. If you have a violent move in the equities, very often you get to see that move that basically replicates, or kind of like a Doppler effect, end up affecting some other market, maybe crude oil. Okay. Yes, Maka, thank you so much for that. Thank you so much for that, Maka. That's great. Thanks for that. We'll certainly talk about that today. Okay. That's perfect. So therefore, diversification, I was saying that it's very, very often misunderstood. And one of the concepts I threw out there some time ago was that diversification, more than putting different assets in different baskets, should be a process by which what you do is to really shoot for consistency or continuous type of results. Outcome out of that portfolio, instead of being diversified and some of those markets counteract other markets, and therefore you end up with no continuous results out of the portfolio because some markets counteract other markets. So this concept is important for us to understand, because in a perfect world, if you had the perfect diversification strategy, basically you make no money, because all markets are 100% non-correlated with others, and therefore they totally, absolutely counteract each other. So when one market is going up, the other one would be moving down at the same pace, and therefore you would end up making no money, because one is making X amount of money for you while the other one is losing the same amount of money. So your net result would be flat. Okay. So the idea here is to build portfolios where we're gonna try to accomplish all those different objectives I just mentioned. We want to create diversification, but diversification that makes money, not diversification that flattens out the result. We want to create diversification that produces consistent results. We want to create a portfolio that can be adapted to what the market does as the market changes, because markets do change. Okay, and at the same time, we want to maintain the risk under control while we expose ourselves in a way where we are ready to maximize our profits the most we can. Okay, that's the idea. That's the goal. And of course, what I just phrased, I guess it's like that would be the perfect portfolio. Okay, if you were to define it. And well, guess what? That's exactly what we're shooting for. And of course, nothing's going to be perfect, because nothing is perfect in life. There will be times you define a portfolio in a certain way and the market changes condition, and then the results is not 100% what was expected. The results divert from what was expected, and this is the real life. This is the real trading. But from a planning point of view, we will be shooting for those ideal results, okay, and then keep readapting as market conditions would change. Okay, that's the plan. This is kind of the philosophy around the concept that we're gonna explore today, and I would love it if you guys could go ahead and confirm with a quick yes, Jose, something like that, that you are following this initial introduction, so we can begin with the rules. And as I go over the rules, you will understand automatically the philosophy behind what we're looking for to build a portfolio. Okay, because basically the rules will define it. Good. So let's begin. So rule number one. Okay, rule number one. Maximum 6% risk for the whole portfolio. So what does that mean? And I believe that we did talk about this rule before. Okay, well, that means that at any moment in time, your portfolio should not be exposed to more than 6% risk. Okay, and again, this is going to be a proposed parameter which is coming from common sense, experience, etc., etc. Obviously, all those parameters can be changed by you. You may say, okay, I'm more conservative. I want maximum 4%. Nothing wrong with that. But your results will be less powerful. Okay, you may say, okay, I want more than that. I want 10%. I want 25%. you can certainly do that. I mean, anything could be done, but definitely if you are exposing your portfolio to maximum 25% pain, there will be times that, I mean, if it's your own money and you are happy to take it, it's fine. But I'm telling you, if you are managing other people's money, I'm telling you, your customers will abandon you if you ever lose 25% of their money. Okay, so again, 6% makes a lot of sense, but feel free to switch or change that number to anything you think makes more sense. In your case, just be reasonable. Make sure you don't change it out of grade. Okay, so this would be my initial proposal for you guys, 6%. Now 6% means the worst case scenario. So let's say, for example, you buy calls that cost you premium. Okay, they cost you premium. So question, if you buy calls and they cost you premium, so what is the most you can lose? Well, the most you can lose is the premium paid, right? So let's say together with the calls you bought, you also buy puts. Okay, so you buy calls, you buy puts. Okay, the puts you bought also cost you premium. Okay, so what's the most you can lose? Well, it's the premium you paid. Okay, so what's the maximum risk? Well, the maximum risk is all the money paid from the call side and all the money paid from the put side. All of this is the total amount of premium which is at risk. Now you may say, wait a minute, Jose, wait a minute. All of these would not be my risk, because let's say I have paid $1,000 for the calls and I have paid $1,000 total for the puts. Okay, so based on what I just said, the total risk, okay, the total risk would be 2,000, isn't it? The total risk would be 2,000, and maybe someone says, wait a minute. Shouldn't be the total risk maximum 1,000 instead of 2,000? Because if I buy the calls and the markets go up, the calls will make me money and the puts will lose money, so I will lose 1,000 maximum because the calls will go up. Or vice versa, if I buy the puts and I spend 1,000 and the market goes down, the puts will make me money, so the most I would lose is what I pay for the call, which is 1,000. So someone may be thinking, well, yeah, even though the total cost for the trade was 2,000, the maximum risk I have is 1,000. Okay, and that makes sense as a thought, but something that you need to know is that there will be times, okay, and believe me, if it hasn't happened to you, it will. There will be times where, let's say you have 10, 20 positions running in your portfolio, some are long and some are short. There could be times, and there will be times, where all those 20 positions, they may move against you. And that would be like Murphy and all his family members all against you. But believe me, that will happen. There are times where it's like you could not believe it, and it's like, how can that be possible? All my positions that are offsetting each other, diversifying, they are all moving against me. That will be a rare case, but it could happen, and it will happen. So risk management means to plan for the worst case, and therefore whatever amount of premium you have at risk maximum, in this case is 2,000, that would be the portfolio risk. Okay, on top of that, let's say on top of buying $1,000 of calls and buying $1,000 of puts, let's say you have done some non-directional trades. Okay, if you do some non-directional trades in your portfolio while you are doing directional trades in your portfolio, those non-directional trades, okay, they have ideally a delta which is zero. Okay, they have zero delta. Well, of course, that's at the beginning. The moment those trades those markets starts moving, your non-directional trades will capture a little bit of positive delta, maybe a little more, or a little bit of negative delta, maybe a little more. Okay, so the delta may be positive or negative, a little bit higher, a little bit less high, whatever that is. But remember, the maximum risk you get in the non-directional trades is not based on the delta, okay, or based on the premium you paid. Actually, when you do non-directional trades, you are being paid premium. Okay, you are not paying premium, you're being paid premium. So what is the risk in a non-directional trade? Well, typically the risk is the distance between strikes, okay, minus the premium paid. Okay, this is something that probably sounds familiar from prior sessions that we have done together. isn't it? Let me give you an example just to clarify. Okay, so let's say you have done an iron condor where you bought the 100 call and you sold the 99 call, and then you sold the 80 put and you bought the 79 put. So what is the distance between strikes? 1. What is the distance between strikes? 1. Let's say instead of 1 and 1, okay, you got 1 and 2. So 99 to 100 is 1. 78 to 80 is 2. So what's the maximum risk? The maximum risk is to lose 2. Okay, that condor will either lose 1 on the upper part or lose 2 on the bottom part. Okay, so the maximum risk, okay, max risk is 2. But for you to take a risk of 2, you have received premium. So let's say the amount of premium received when you did the condor. Let's say you have received 50 cents. Okay, so you have been paid 50 cents to do this condor that has a maximum risk of 2. Well, if that's the case, the most you will lose is 2, but you get paid 50. Okay, so what is your maximum risk? 1.5. Okay, so the non-directional trades, the risk of the non-directional trades will not be the cost. Oh my God. Yes, it will not be the premium you paid. Okay, I was looking at the way I worded this. That was a little funny for a minute. So the risk of the non-directional trades, let me repeat it, is not the cost you paid in the form of premium. It's the distance between strikes minus the premium received. In this case, let's say is 1.5. So let's say you have 2. Okay, let's say you have 2 non-directional trades in your account. Okay, where you have a maximum risk of 1.5 each. Okay, and remember 1.5 in the world of options is always times 100, so that would be 150. Okay, so maximum risk of 150 times 2, that would be a maximum risk of 300. Okay, so what would be your total risk? Okay, well, the total risk would not be 2,000, would be 2,300. And again, you may be thinking, okay, but wait a minute, if the market doesn't move up and the market doesn't move down, and it's like the most boring market in the world, so then of course I understand I would lose 1,000 and 1,000 because my calls and my puts would make no money, would lose no money. But because the market is so boring, my non-directional trades would work well, so really I don't have 300 of risk. So should my total risk be 2,000? And the answer is again no, because when assessing risk, we need to be the most skeptical as possible. You need to pretend or assume that all your positions are moving against you. Okay, and what are you gonna do if that's the case? You need to have that worst case scenario under control. Okay, and again, I'm not saying this is gonna happen often, and it should not, but it will happen. There will be times where you will be like, oh my God, and you will remember my words. Okay, you will. Because it's part of trading. There are times where all your positions will go in your favor. It's not going to happen all the time, but it will. And there will be times where all your positions will move against you. Okay, and you need to have that situation under control. Okay, so concept number 1, maximum risk is 3%, but we are talking about the real risk, and we are talking about the real risk for the whole portfolio by being the most pessimistic you can be. So we are pretending all the trades are losing maximum. Okay, that's what that 6% means. Okay, and then if you want to change that figure, it's fine. But the concept is the real risk in a pessimistic, with a pessimistic approach. Let me take a look at your comments, and please give me confirmation that you were me, guys, with a quick text. Bojan, how are you, my friend? Jose, is this Word document part of the longer-term trading document or a new one? This is like a very long document that has right now 34 pages where I keep typing every time we do a sharpening session. So this is not the most organized document in the world, but it has everything in it. Dehide, yes, don't forget O'Toole, who always said Murphy is an optimist. Very good. Yeah, good humor. And by the way, even though it's funny, really is not funny when that happens. Okay, so that's why we need to have it planned ahead of time. So when it happens, it's not like we are now paralyzed and with this blank face and we don't know what to do. Okay, we need to make sure everything is under control. Okay, so let's continue. So first concept, maximum 6% risk for the whole portfolio. So anything I'm gonna do will imply keep building or adding positions in order for me to get that maximum risk. Okay, and the goal, by the way, by the way, the goal is to reach that level of risk. Okay, the goal is not to maximum I would risk 5%. I hope to never risk 6%. Okay, the goal is I am willing to risk 6%. I am not willing to risk more than 6%, but I am willing to risk 6%. That would be the goal. So we need to keep adding positions until we reach that threshold. Okay, if your account is under position, two things may happen. You will make very little money and therefore you're not going to be satisfied. That's one possibility. The other possibility is that if you are under position, you may not be hedged enough. Okay, so when you set your maximum risk parameter, it also means you are planning to reach that figure. Okay, it's not a worst case. It's not like, okay, if I feel positive today, maybe I'll take 6% risk. No, that means that this is what you want for every day for your portfolio to be assuming. There is no reward unless there is risk. So we are setting this as our parameter. Okay, and again, the goal is to reach that level of risk, but we also need to make sure that we don't reach that level of risk, by forcing trades. Okay, so the goal is to reach that level of risk without forcing trades. In other words, if you were to look at the market today and let's say that none of the stocks you have assessed is meeting your rules, and therefore if you were to take the trades, you are actually bending the rules or breaking the rules, then that would be completely unprofessional. Okay, so we are shooting for that 6% risk. We're shooting to be there. We are never going to surpass that, but we will at times have to be under 6% if the market is not giving us enough opportunities. Okay, let's say for example you want to do a non-directional trade and you run the scan. Okay, and when you look at the ND, your list is empty. Okay, your list is empty, meaning that there is no trade that meets your criteria. Well, then you cannot take the trade and therefore you will be under position. Okay, so I rather have you under position without breaking your trading rules that have you properly positioned, but all your trades are low probability because none meet the rules. Okay, so it's important that you understand the concept. And by the way, the most difficult time to build a portfolio is when you begin. Okay, the first day that you have no trades running and you need to start adding trades, probably in one day will not be enough to build all the positions you need. So maybe take a full week to have the portfolio running the way it should. And from there, every day you are reaching targets, having time decay, reach expiration. Every day, every week, things are happening, and you just keep removing some positions, adding some positions, and then it's very easy to maintain. So the toughest one is when you begin, where very quickly you should be adding multiple positions at the same time to reach that 6% risk. Okay? Cool. Now, that's the first concept. Now, second concept, when building the portfolio, you need to use some sort of a guide. Okay, so we need to use a guide. We need to use a guide that dictates how much exposure. When I say how much, I mean many things. Okay, as you will see, I'm going to talk about Greeks. Okay, how much exposure from a theta point of view, how much exposure from a delta point of view, how much exposure from a gamma point of view you want to have. So we need a guide that dictates when we are building that portfolio, adding that 6% risk. Okay, what do we want to add there? Do we need to add today non-directional trades, or today is time to add longs? Do we need to add shorts today, or today is time to add longs? So we need a guide. Okay, we need a guide that dictates how much exposure, how much and which and what type of exposure we need. Okay, so now the guide that we're going to use depend on the markets that you trade. So some of you may be doing what I'm explaining today in the US markets. So if you're doing that with the US markets, classical way a classical guide would be to use the S&P 500 as a guide. But what if you do it in Europe? Well, maybe you use the Euro Stock 50 as a guide. Okay. What if you do it in China? Maybe you're using the Shanghai Composite Index as a guide, right? So depending on where you are in the world, you may have to use a different guide. If you're in India, maybe you're using the Nifty, right? So everybody's gonna use a different guide. Okay, so that's why I'm calling it guide, even though in the examples today I will be using the S&P, which is what I believe that most of you will be using. Because I mean, even if you live outside of the US, which I know many of you do, probably still a lot of your trading happens to be in the US, because nowadays, you know, it's still the most advanced market in the world. This may be changing actually quite soon, but not yet. Okay, so still a big reference out there, and especially if we're going to be using options. Okay, definitely they are by far the most liquid markets in the world at this moment in time. Okay, so as you can see, I got in the background, I got TradeStation, and I got the SPY ETF. That's the one I'm going to use as a guide in the session. If instead of using the SPY ETF, you prefer to use the index itself, and therefore you use the symbol $INX, if you use TradeStation, or if you use another platform, maybe you use SPX, it's the same thing. Okay, the difference between what the ETF does and what the real index does is about the same. If you were to use S&P futures, it's also very similar. So, you know, it really doesn't matter too much, because the way we're going to use the guide, as you will see, will make it that, you know, no matter if you use the ETF or you use the index or you use the futures, in the end, our signals providing from the guide that tells us how to build a portfolio, dictating how much and what type of exposure we get, you will see they would be the same. Okay. Now, if your portfolio was to be very narrow, and you were, let's say your style of trading has you to trade only stocks found in the Dow Jones Index, okay, which is 30 stocks, right? Or you love the technology sector, and for you it's all about Nasdaq stocks. So then you could use as a guide the Nasdaq index, you could use as a guide the Dow Jones index. Again, if you are an international trader and you are focusing on the Indian market, well, maybe you use the Nifty as an index. So just pick an index that represents the best, the type of markets that you plan to use in your portfolio. Okay. Now, some of you may say, well, wait a minute. Okay, what if I have bonds in the portfolio? What if I have metals in the portfolio? Well, then I would treat those markets separately, totally, completely separately. Okay, so what I'm about to explain today is for equities. Okay, so maximum 6% risk of the whole portfolio. Okay, that is for equities. Okay, if you plan to add other markets, okay, that are non-correlated with the equities, okay, and that do not provide many sub-components like equities do. Okay, so let me explain that. For example, if you trade crude oil, if you have crude oil in your portfolio, I mean, yeah, you have Brent oil, you have a few variations of oil, heating oil, 5 maximum, you know what I mean? Plus, do you have options for that? No. If you are doing gold, how many golds you have? A few golds. Maybe you trade golds in different countries. Is it going to be that different? No. If you're trading bonds, you can do the 10 years, the 30 years. Do they vary? Of course they vary. Is it a lot of difference? No. So basically, those will be treated separately. Well, with equities, okay, you got close to 9,000 stocks in the US market, and you got certainly, let's call it 200 stocks with options that may be liquid enough for us to do what we need to do. So we do have many subcomponents that you can play with to have diversification within that particular type of instrument. In this case, we're talking about equities. Okay, so if you're going to use other markets that are non-correlated with the equities, but you don't have, I forgot the not, that do not provide many sub-components like equities do, okay? So then what you will do is that you will need to allocate, okay? You will need to allocate a fixed percent of your capital to those instruments, okay? And to be honest, the way I think it would be best for you to be very focused on your trading is that to use different accounts for that. So instead of having crude oil longer term trades together with gold longer term trades, together with treasuries longer term trades, together with equities longer term trades, probably the best way would be that you use a different account for that. Okay, and you can have a portfolio made of multiple accounts, and every account had a specific decision when it comes to percentage of capital to be allocated. For example, you are creating your own hedge fund for yourself and your family, or maybe you are managing third-party capital, and you decide, okay, so our philosophy is going to be that we want to be exposed 3% to cryptocurrencies, and we want to be exposed 5% to normal currencies, and we want to be exposed 10% to bonds, and we want to be exposed 10% to metals, and we want to be exposed another 10% to crude oil. Okay, and all of these may be like 30% of your money. So what do you do with the other 70%? With the other 70%, you're going to have the biggest portfolio, which is going to be with the equities, creating diversification via the Greeks, which you could do with the equities, but you cannot do with the bonds and the crude oil and the natural gas and all those other markets. And that's why I suggested to have it in different accounts where you had specific static definition for how much capital you have there. Okay? Orlando, Jose, are those rules related to an options portfolio? Well, options are going to make you way better as a trader to do this. So my natural answer would be yes. But you will see later when I get into the Greeks, okay, and how we use the guide that dictates how much and what type of exposure we need. And one of the Greeks, of course, is going to be delta, right? And you know that delta equals represents the equivalent amount of shares that a stock trade would have, isn't it? So in other words, you will be able to do what I'm about to explain without the options. Okay, so let's say you are doing. Oh, got it. I hear you, Orlando. So let's say you are doing this trade let's say you are doing in the Chinese markets, okay, which is a fantastic market with like 4,000 stocks, but unfortunately options are not too liquid, and basically you have options in only a few instruments. So then you cannot do what I'm about to do. Okay, well, what could you do? Well, you could do it with the shares. You will just do it with shares without using derivatives. Okay, so you will see that in a few minutes from now. It will make sense. Okay, so again, so maximum risk for the whole portfolio for the equities part. Okay, because for the other assets, as I said, you would have your specific allocations. Okay, and by the way, probably the simplest way to do this is to use equities for the whole thing, because you will see that if you're going to use options, we can produce diversification via the Greeks, which is actually more powerful than producing diversification combining assets. I mean, let me ask you this question, okay? And you don't need to answer, but I would love it if you do. How many of you have ever had a portfolio with multiple ETFs? I'm talking about longer term trades, okay? And how many of you have had a portfolio with multiple ETFs? Maybe you had TLT, SPY, you had crude oil, you had gold, you had, a bunch of ETFs, and, you've been holding that thing for a year, and let's say the markets have been moving nicely that year, but then your net result is like half of what the market has done. Anyone has been there? Okay, again, not too nice as a question in the sense that I'm kind of asking you to kind of publicly express that you have been frustrated with your portfolio, which may not be easy to say if you wish, but this is a forum where we're all professional here, so we need to understand why that happens. Okay, or mutual funds. Thanks for that, Bojan. So why is that happening? Because diversification kills performance. Okay, if you use like more or less the same amount of capital for different assets, and you hold them all at the same time, basically you are just working for Wall Street, paying fees to Wall Street, and you are safe. I will say that you are somehow, you do obtain certain level of safety. Why? Because you are removing a lot of the risk, and therefore what's going to be your reward, right? So it's going to be very disappointing in most cases. Okay, so thanks for acknowledging that, Orlando and Bojan. And again, if you have not been there, know that would happen. Okay, so that's why I want to expose you to how hedge fund traders will do when it comes to producing portfolios to produce much more interesting results, instead of having to be happy underperforming the market. Okay, which is what's happening to most investors out there. Okay, so again, let's go back to this last concept, okay, because that's the key. Okay, so we're gonna have to use some sort of a guide. The guide that we're gonna use to dictate how much and what type of exposure we need within the portfolio, okay, it's going to be the S&P, in my case, in the examples I will be running on my side. Okay, because I think it's probably the most generic example, and probably is the one that works for all or most of you. But again, you could use anything else. Again, Nifty, Eurostock 50, Shanghai Composite Index, Singapore Composite Index, the Straits Times Index, the Dubai Index, you name it, right? Just pick whatever market is your bread and butter and use a relevant index in that place. Okay. So now, when looking at that particular market, okay, and I would like you to focus on my bottom chart on the bottom left. I have the S&P in the daily time frame. Okay, again, comment about the time frames first of all. You probably remember this. Give me 1 second. You probably remember this, isn't it? That for the longer term traders, we either use the daily or the weekly or the monthly, isn't it? So those are the 3 time frames that you will be allowed to use with your market guide. Okay, the market that will give you signals and indications of what do you need in your portfolio. Okay, so if you want to be a longer term trader and you want to be in the active side, then you would use the daily. Okay, and because this is more or less my personality, then in today's session I will be using the daily. Okay, but know that if you are a little bit more long term, a little more passive as a longer term investor or trader, then you can use the weekly. Okay, and do exactly what I'm going to do with the daily, but do it with the weekly, and that would make everything in your portfolio to react more slowly, and give you more wiggle room for you to understand if you're right or wrong, and therefore waste a little bit more time if you're wrong, but if you're right, make sure that you end up capturing longer moves, longer lasting moves, etc. Okay, and if that's not long enough for you, then you can also use the monthly. Okay, so again, I'll be using the daily because I think it's more relevant or more representative of at least who I am as an investor or trader. But you could certainly use the weekly and the monthly too. That would be certainly valid. Okay, so keep that in mind, and I believe all of you are with me with this table. If you are a little lost with this table, just let me know and I will quickly re-explain it. Okay. So what am I looking at? I'm looking at the S&P. I'm using the ETF in this case. I am also pointing at the daily time frame. Okay, this is the time frame I just said I'm gonna use. Okay, and now when looking at this chart, okay, a few things may happen. So what may happen when looking at this chart is, that we can be in front of a confirmed market condition. Okay, confirmed market condition. You know what? I'm just gonna come up with a new word. Okay, confirmed climate. So the climate in the market. Okay, and if you guys feel it, these words sound funny, just let me know, because as you know, English is not my first language. Okay, so feel free to tell me this sounds terrible. Okay, I'll take it. No problem. I will not be offended. Okay, so you can be in front of a confirmed climate, meaning that the climate in the marketplace is well defined, is very sunny, or it's the weather is terrible, right? So the climate is confirmed, okay? Or you can be in a climate that is unconfirmed. Okay? So the climate is unconfirmed. Okay? That could be another situation. Okay? Or the other case could be that the climate is risky. Okay? Climate is risky. It's not raining yet, but oh my God, look at those clouds, right? So we have three cases. Okay, we're gonna define three cases, and we can make these crazy complicated, or we can keep it simple. Okay, so I'm not gonna exceed more than three cases, because that's more than enough to take care of the key situations in the marketplace, and therefore that's gonna be fine. Now, once you understand the philosophy of what I'm building here, I know some of you are very experienced out there. You have been managing capital for a long time, and if you want to take this approach to manage a portfolio, and you want to create, instead of 3 climates, you want to create 5 climates and put rules around that, etc., you can certainly do that. Okay, but I want to keep it simple, first because that's what I do for myself, second because simple works, okay, and also not only it's easier to understand, but also it takes less time then to manage and stuff like that. So I want to find a little bit of a balance. If I was to do this with the weekly or the monthly time frame, maybe I can find more type of climates, if you wish, but with the daily time frame, I will have to do management quite actively, and because this is for longer term, somehow I am willing to do active management, but I don't want it to be too active, because then I become a day trader, right? So, trying to find a balance, that's how with time and experience, I concluded that 3 is a good number. Okay, so just sharing with you these comments, this approach, this philosophy, but again, as you see it, feel free to tweak it for yourself. If you have experience in your own field and so on, and you want to make it a little more complex, okay? So what is a confirmed climate? Okay, so what is a confirmed climate? What is a risky climate? Okay, and what is a non-confirmed or unconfirmed climate? What does that mean? Well, remember, when we trade, we have very simple rules that we apply to the chart. Okay, so what is our first step? Our first step when we trade is to look at the prior close and look at if the prior close is above or below the average. Okay, and then we look at the DMI to see if the DMI confirms what the upper side says, right? So in this case, what do we have? We have a close below the average. That means the market is falling. Okay, the market is falling. Using market analysis terminology, I would call this a downtrend, isn't it? But being this a downtrend, based on conventional terminology, the fact is that we got the DMI being blue, which means that the pushes that we find in the marketplace are stronger than the pushes to the downside that we find in the marketplace. Okay, so there is more strength kicking to the upside and less strength kicking to the downside. In other words, the market is going down, okay, but we have a little bit of a contradiction between what the DMI suggests based on what the real price movement has done being below the average. So what would that be? That would be an unconfirmed climate. Okay, in other words, an unconfirmed climate is the same thing as when we are doing our regular trades, okay, every Tuesday or Thursday, and we have a weak market environment. So when we have a weak market environment, we will call that climate to be weak. And when that climate is weak, we will want to position our portfolios to 50% delta exposure. Okay, and you will see what that means in a minute. Okay, in other words, if the climate is not confirmed, I don't want to take more risk to the upside. I don't want to take more risk to the downside, because I have a contradiction between the tools I'm using to understand the climate. Okay, one is telling me it's going down, the other one is telling me it's going up. So I don't want to have a strong bet on the direction, and therefore I'll want 50% of my deltas to be long, and I'll want 50% of my deltas to be short. Okay, so I'll want 50 delta exposure. That's what I want. Sorry, guys. Okay, this is what I will want. Okay, like that. So now, what would be a confirmed market condition? Well, a confirmed market condition is, for example, at this time. Okay, you had a close above the average. The DMI confirms what is above. So you have a confirmed market condition where not only the market is proving to move up as an average, and that's why the close is above the average. On top of that, when the market is moving up, it's pushing stronger to the upside and pushing less strong to the downside. That's why we got the blue color showing up instead of having some red color showing up, right? So when that's the case and you don't have a contradiction with the upper part of our chart and the bottom part with the DMI, then we are talking about a confirmed climate. This is when we use the word strong in the Tuesday and the Thursday sessions, isn't it? We said the market is strong, right? Strong going up, strong going down. Okay, so it's a confirmed climate, okay? And in this case, then what I want is I want 66% exposure in that direction, and I want 33% exposure in the opposite direction. Okay, so in that case, since in that particular case, since the close is above the average and the DMI is blue, then you will want 66% of whatever delta you have in your portfolio, you will want it to be positive delta, and 33% of the remaining deltas on the portfolio, you will want them to be negative delta. That's what you would want. Okay, you will want this type of distribution of deltas. Okay. Let me move to the back. Let me move left on the chart. So I show you examples of the opposite. Okay. So for example, at this moment in time, we have closes below the average. Okay, close below the average. The DMI is red. Okay, so what is that telling you? That's telling you the upper market movement is confirmed by the DMI. So we are in a confirmed climate. Okay, we are in a confirmed climate, and therefore, we are ready to position ourselves with 66% of our deltas to be negative and 33% of our deltas to be positive. And what is a risky climate? Okay, well, a risky climate, okay, is when a market went too far, too fast. Okay, why? Because then it's, earlier I was using the word strong, isn't it? So when a market goes too far, too fast, it means it's strong. But the problem is that it's way too strong. And so in other words, the market is making way too strong of an effort, and therefore it may not be something that you can rely on, because it may not last forever. Okay, it's just like everything in life. If the push is too strong, it will tend to revert back to the mean before the next push. Okay, so how can we assess a risky climate? Okay, well, I'm going to activate a new study that I have not used up to this point in the sessions, which is the commodity channel index. So for you to insert the commodity channel index in your charts, you will go for study, you will click add study, and then you will look for C, which is the first letter of commodity channel index, and here you have it. Okay, in some platforms it may show as CCI. In TradeStation it shows as com channel index. So when you insert that indicator, it's gonna look like that. Okay, I have on purpose position the commodity channel index on the top part, because I will almost never use it, only when I need to decide what do I need in my portfolio. Most of the times I'll have it hidden, so I don't really need it, but from time to time you'll take a look at it. Okay, this is not a tool that you will utilize to know when to buy, to know when to sell, to set targets. You will not use it for that. You only use it to identify if the climate is risky or not. For example, at this moment in time, we have a close below the average. The DMI is red, so this is telling you, okay, it's a confirmed climate. The market is going down. You want 66% of your deltas to be short and 33% of your deltas to be long, correct? But the CCI is below the green line, which, by the way, I need to explain the meaning of those lines. I'm going to explain it right now. But basically you can see we got that red color on the CCI, and that tells you that the market has been moving down too far, too fast. Is it sustainable? Probably not. Therefore, you have a risky climate. Is that case where it's still sunny, okay? It's still a good market condition for you to trade, still sunny. You would think that you still want the deltas, right? But wait a minute, the clouds are coming, okay? And the clouds doesn't guarantee it's gonna rain, but they increase the chances that it rains, and the rains means that the market will change from confirm to unconfirm. Okay, so what would you want to do in this case? Okay, well, you would want to be cautious. Okay, and if this happens 2 days in a row, okay, so if you see clouds 2 candles in a row, then you would assume that the market that the climate is unconfirmed and switch back to 50-50. Okay, you will do that. Okay. Here. So anyway, let me go ahead and you guys have been very quiet for a little bit of time now. Please, guys, go ahead and give me a little confirmation that you're still alive, everything is good. Before I keep going, I want to explain about the CCI so you understand what that is and how it works and the parameters that you should be using, etc., etc. But I also need a little bit of confirmation that you are following today's lecture and everything is making sense. Even though the real sense will be at the end when you see all the pieces of the puzzle together, right? But anyway, I want to make sure that I'm not leaving anyone behind. Good, perfect, nice. Okay, so let's talk about CCI. Okay, so the CCI is what is known in the world of technical indicators as an oscillator. So if I maximize the chart of the S&P, and I was to go back in time for a long time, and again the CCI is on the top, isn't it? So notice how the CCI goes from red back to blue, back to red, back to blue, back to red, back to blue, back to red, back to blue, etc., etc., etc. Okay, you see that? So what does that mean? So technically speaking, and I'm going to use a little bit of technical analysis language. Okay, so if you were to be a technical analyst, okay, or market analyst, you would be told that this is an oscillator and it oscillates between oversold signals, which is when it goes down here, and overbought signals, which is when it goes there. And how does that indicator find out that the market is oversold and overbought? Because in the end, this is a mathematical calculation. Well, this is done by calculating an average, which is 14, and on top of the average, what CCI does is it also add a standard deviation calculation. Okay, it applies a standard deviation calculation on top of the average. Okay, and when the market reaches that point, okay, it creates that calculation, which if that calculation surpasses plus 100, which is the upper line, as you can see, 100 is here. Okay, so then the indicator changes the color to blue, because then you assume that because the market is above the average and surpasses the 1 standard deviation, just like when we do iron condors, isn't it? We use 1 standard deviation. So anywhere between these two lines, it's likely to happen. But when you go above, okay, when you go above those 2 lines, okay, when you go above, oh sorry guys, I'm just using the wrong drawing. So when you go above these 2 lines, or when you go below these 2 lines, okay, those conditions are less likely to last and are more in the extreme side, and something is about to change. Okay, and this is what this is calculating. And of course, this is going to be quite weak when it comes to being precise with timing, but it's going to be good when it comes to reallocating deltas in your portfolios to to manage your risk, okay, re-enter new positions, offset risk, etc., etc. Okay, so notice here we got a pierce below. Okay, if I move down in a straight line, well, above it's saying that it's supposed to be, okay, it is supposed to be oversold, so the market is supposed to go up, but before it went up, look at how much move it still continued dropping before it finally reversed and started going up. And then here the same. Here the market is supposed to be the market is supposed to be overbought, meaning that from there is likely to fall. But notice that it kept going and going and going and going, and really there was not a significant drop until more or less here, okay, which was the end of the blue zone. So in other words, those indicators are not precise. Okay, so for you to decide when to buy and when to sell a stock, you should never do that. But to reallocate deltas on a portfolio, it's precise enough, because remember, the directional trades that we use with options not only are positive or negative delta, but what else are they? They are also positive gamma. Do you guys remember gamma? Okay, and if you don't remember, you need to, whenever you have the time, go back and review the session that we did on gamma, okay, which is recorded on the YouTube channel, isn't it, in the playlist? Okay, so even if you are not too precise, the gammas will help your deltas, and because you will always have offsetting positions, right? So you will end up mitigating the risk while you maintain some level of profitability. Okay, of course, the greatest profitability you want to make, because it's less risky and more likely, is in the beginning of the move, and the ender part of the move, it's okay to give up some profitability, right? Correct. So that's the idea. Okay. So we're gonna use that indicator, that CCI, to identify when the clouds are showing up on the sky, and we now have a risky climate instead of a confirmed or unconfirmed climate. Okay. This is what we're gonna do. Good. So we'll use maximum 6% of the risk. The goal will be to reach that level of risk without forcing trades. We need to use a guide that dictates how much and what type of exposure we need. I am using the S&P 500, which I'm using SPY. And once you use that guide, okay, you will then, using the common time frame, okay, which is daily, weekly, or monthly, you will assess the climate that will define the delta percentages that you need based on the below table, okay, which are those three those three particular cases. Okay, now apart from the delta, okay, we will also need to look at the gamma, and we will also need to look at the theta. Okay, so for the gamma, it is a must, okay, that gamma is positive. Gamma has to be positive. If gamma is not positive, your hedges will not work well. Remember when we have done damage control, right? Remember when we talked about how gamma works? You need to have positive gammas, okay, in order to make sure that, for example, the case I just explained, where you may have a red on the CCI, okay, and this happens starting from these candles here on the top, but before the market reversed, okay, you still have a little bit of extra drop. Okay, while you're having that little bit of extra drop, if you are positive gamma, your short position will profit more than the longs. okay? But if your gamma was to be negative, then you're going to be in a big problem. If you are switching to 50-50 delta once the climate is risky, which is what I'm asking you to do, right? And your gamma is negative instead of positive, then you're going to lose, right? So it is a must that gamma has to always be positive. And as a little reminder, the net gamma for the portfolio, very good, Maka. The net gamma for the portfolio, okay? So all of this has to do with the portfolio. 63, 33, 50, 50, positive gamma, all of this applies to the portfolio as a whole. And again, I'm going to look into that. You know, when I'm finished with this explanation, I'll give you a break. And then when we come back, I'll show you how we do it, okay? So the gamma has to be overall positive for the whole portfolio. Reminder, non-directional trades, which are credit, create negative gamma. Directional trades, which are debit, produce positive gamma. So in other words, you need to make sure you have a directional trades in the portfolio running for you to be allowed to enter non-directional trades. Because if everything you had in your portfolio is non-directional, right? Well, in one sense, it's great because you have plenty of theta and you make money on time passing, and that's a sure thing. Congratulations for that. But then if the market was to move violently up or down, and you have 3, 4, 5 non-directional positions in your account, that week, that month is going to be very, very ugly, okay? Well, if you have directional trades while you have non-directional trades, and the market moves fast, then the directional trades will make more money faster than what you lost on the non-directional, okay? And therefore, you're going to be in a healthy situation, okay? And you're going to be fine. So you need, for many reasons, you need your gamma to be positive. That's very important, okay? It would be a mistake as an options trader to only do non-directional trades. That would be a mistake, okay? And careful with that, because this is something that is very, very, very heavily promoted out there in the world. You buy an options book and they will tell you iron condors is the best thing you can do. And they are great, and you know I love them, and I love to plan them, and I really love them to the bottom of my heart. But not to be done on their own, right? So why are they promoted so much out there in the industry? Well, very simple. If you buy a call, how many times you pay commission? 1. If you do an iron condor, how many times you pay commission? 4. It's 4 options. So who do you think promotes those strategies so interestingly? It's the brokers, it's the industry, right? Because they want volume, the market makers, everybody wants those trades. It's more options, right? And it's more options to be executed. It's more business for the industry. So, I mean, again, I love them. We love them. I'm sure some of you love them too. I'm pretty sure. But it would be risky that you only have iron condors or non-directional trades in your portfolio, because there will be many months where you make a lot of money, but there will be also months where you are really very badly hurt. And then you need 3, 4, 5 months just to recover from that 1 month. Okay, so we need positive gamma to have this active hedge in the portfolio. Okay. Behind any short position in the portfolio would be negative gamma, so no short options. Yes, short options is fine. Okay, but as long as you have other trades in your portfolio that produce positive gamma. So let's say you have 2 bull call spreads, right, which both produce positive gamma, and then you have an iron condor, which is short options, or you have a short put, which is short options, that will produce negative gamma. So as long as the negative gamma from that third position is less than the positive gamma from the prior 2 positions, it's fine, because your net gamma exposure for the portfolio as a whole is positive. What would not be safe, and I'm not saying you cannot do it, but then you will not be diversifying your portfolio the way I'm suggesting. You will not be hedging, okay? Then what will not be prudent will be that you only have shorts, either non-directional or neutral, or short puts or short calls, or bull put spreads, or bear call spreads, or iron condors only, or short strangles only, or iron butterflies only. In other words, all credit trades. If everything you have is all credit trades, you are massively negative gamma. If the market moves fast, you will feel too much pain. You will surpass what you should do in a reasonable world where your goal is to manage risk. Okay, so here's the idea. Remember the beginning of the conversation. The idea is to mitigate the risk while we maximize the amount of profitability the most we can. Okay, but also remember, mitigate the risk. Okay, and therefore we have to be hedged, and the only way to be hedged in a way that is dynamic is to have positive gamma. Okay, so we need that. That is a must. Gamma has to be positive. Okay, and then the theta, and I'm gonna reread all your questions in a minute because I think I'm missing one or two. Theta, okay, ideally, okay, we want it positive too, but that's not always possible. Okay, that is not always possible because depending on sometimes you are in a confirmed climate, so you want to be 66% exposed to the long side with positive deltas, or to the short side with negative deltas, and because to get those positions you're going to be using positive gamma positions, which are debits. You pay debits are negative theta, and therefore it will be not always possible to have positive theta. So if you cannot have positive theta for the portfolio overall, then you will want your theta to be the least negative as possible. Okay, so ideally positive. We'll take it if it's negative. Okay, but let's try to make it as negative as possible as you select trades to be added in your portfolio. Anyway, so, and by the way, that's more or less all. Okay, so I'm sure I will add a little more here, but not so much more. Okay, so let me read your questions. I'll give you a break, and then we'll do it. And when I do it later, everything will fall into place. You'll see. So, let me see. Okay, so Charles, I missed your question. You had some tech problems. What I was okay, got it. No big deal. Okay, so it seems that I did catch up with all the questions, so we are fine. So guys, let's have a 5-minute break, and as we come back from the break, we will build a portfolio following those rules, and as we build the portfolio, everything will fall into place, and you will see how this is actually quite simple. Okay, so 5 minutes. Back in 5. Hey everyone, this is Jose. We're restarting in 30 seconds. I just wanted to have a quick sound check. Please confirm with a quick message on the chat box that you hear my voice. That would be good. I'm sure not everybody's back with from the short break, but if you are around, I just need one or two of you to confirm that sound is good so we can restart. Wonderful. Perfect. Good. So let's continue. Okay, so let's continue, or maybe I should say let's begin, because now we have the rules, and now it will be time to put together the portfolio. Okay, so so again, let's pretend it's day one and we don't have anything on our account. Okay, because the fact is that if I open Option Station Pro, we actually have something in the account. Okay, so I just want to point at a couple of things, but the moment I point at it, I will go ahead and pretend we had nothing. Okay, so in our account, okay, in this account that I'm using during the sessions, I have the positions, right, under the Manage tab, right, and you can see we have a trade with Merck and we have a trade with STZ. Okay, those trades got filled. Okay, and you can see how we have certain columns here where by default TradeStation is giving me the delta. Okay, well, all of this is customizable, and as you know, I am interested in knowing more about the gamma, so I'm just going to move it up next to delta, and I am also interested in knowing more about the theta, so I'll move up next to gamma. Okay, so what do we have here? Well, we have a portfolio where this portfolio overall, you can see the addition is in the bottom. It's producing 37 delta. Okay, this portfolio is made of two positions. It's obviously not enough, but this portfolio is producing 37 delta, almost 38 delta positive. It's producing negative gamma, and it's producing a little bit of negative theta. So first problem, this portfolio, it's negative gamma. That's the first problem. We said we need gamma has to be positive. Okay, so that's problem number one. So we need, I need to add positions to achieve the goal of having a positive gamma. In this case, the problem is that we only have two trades. One with Merck is a non-directional trade, isn't it? Is an iron condor. Let me put it all together, so it's going to be easier to identify. So I'm just going to drag it, and drag it, and drag it, and drag it here. Here we go. Okay, so remove that. Interesting. I don't know why this row stayed there. So we have the iron condor there. Okay, so delete, and then I'll do delete, and then I'll do delete. Here we go. That way, hopefully, it's clear for you. So under Merck, we have an iron condor, as you can see, made of course, 4 options. Okay, but it's one iron condor. That position, as you can see on the top, produces 3 delta, produces negative 4 gamma, and produces 1.97 theta. Okay, so that's great. Remember, ideally theta is positive, so that's good. That's bad, okay, because gamma we want it to be positive. Of course, because it's a condor, it's gonna be a credit. You can see it here too. It's a credit, right? And because it's a credit, it will always be negative gamma. Has to be. So even though this is not ideal, this is the way it is. It will always be negative gamma. Okay, and then we have positive delta, which it's okay, but it's only okay depending on the other positions. And the problem is that it's not okay either, because the position below, it's positive delta, and the position above, is also positive delta. What does that mean? I am 100% positive delta. Okay, I am 100% positive delta, where what we said is that depending on the climate in the marketplace, you will want to be either 66-33 or 50-50. But in this case, we are 100% delta positive, which is, we are breaking the rules with the delta, we are breaking the rules with the gamma, and with the theta, again, not a big deal, because the theta is, if it could be positive, we love it, but, it's most times we will not be positive overall. So it's okay, we'll take it, okay? So now, how do I fix that? Well, the only way I can fix that is to add more positions. So how can I fix the delta? Well, I would need to add negative delta positions. I would need to look for shorting opportunities in the marketplace, so I can add short trades that make money on the way down, that will produce negative delta. Okay, and by doing so, I would be offsetting my portfolio by producing positions that are debits. Okay, this one is a debit. This trade cost me $700. You see that? So by producing debits, okay, this is a, let me put it together. Okay, if I put those two together, that's a vertical spread. This is a bull call spread. So by putting trades together, which are debits, it produces a positive gamma. So if I add a new short, not only it will add positive gamma, it will also reduce the deltas. Okay, let's say I was to add another position which produces a negative 35 delta and then produces positive 1 gamma. Well, if I was to do that, that would be very good for the gammas, because now I got, instead of 0.76, I will have 1.76, which is offsetting more, the not minus 4. The negative 35 would offset the positive 35, that's good, but then I would only be left with 3 delta, okay, which is obviously not 66-33% or 50-50, depending on the market climate. So what will I need to do? Then I will need to look for another position, okay, maybe I will look for another position where, I look for a third trade that may be another negative 35 delta, which adds another plus 1 gamma, and then I look for another trade that is positive 50 delta maybe, and then adds another 1.5 gamma, right? And if I was to add all of this together, again, I didn't do the math very precisely, but let's pretend that now all the gammas kind of counteract each other, and you end up with a little bit of gamma positive. Now I will be happy. Now let's say you add all the deltas, and you got 35 and 50, that's 85. And 35 and 35 is 70, so you have negative 70s deltas, and you would have 85 positive deltas, which is not exactly, but let's, for this example purpose, as I'm improvising it, let's pretend that now you had your delta with the distribution you wanted, where you wanted to either be 50-50 or 66-33. Right, so you will want to produce that portfolio, and then once you added all those positions, then the net theta will be whatever it is, which it will put an extra smile on your face if it's positive. But this will not happen too often, unless the non-directional trades that you do are very, very, very short term, and therefore that number is very, very high. Okay, because the shorter term to expiration, the higher the theta. So these options expire in July 26, so during the middle of next week, that 1.96 may become 5, right? And the moment it becomes 5, then you will see an overall theta being positive, and then you'll have an extra smile on your face. Okay, but this is something that you cannot change because we have no control about time passing. Okay, so that's the idea. Okay, so again, this is what you would do once your portfolio is running. Okay, now what I want to pretend now is that you got nothing in the portfolio. Let's pretend we got nothing. Okay, and you start looking for trades. Okay, so how do you deal with it to come up with trades? Okay, so this is what I would like to do now, but I do need a confirmation from your side, so I understand that you guys are following what I just explained. So Little confirmation from your side, guys. That would be greatly appreciated. Sorry guys, I have muted myself and I forgot to unmute. Sorry guys. So sharpening gamma hedge, that would be the session where I cover the gamma, but then also I talk about it a little bit in the damage control session that we did on July 7. Okay, so those are the two sessions that are the most relevant. Okay. Good. So, and by the way, since we're here, you always remind me that I always forget. Please go ahead and give us a beautiful thumbs up if you're happy with the session, and also if you're watching this recorded and you haven't clicked on the subscribe link and on the bell, this would be your time to do it, so you get notifications and all of that. Cool. So let's continue. So let's pretend you just turned on your computer, you just funded a brand new account that you plan to use to run a portfolio, and you are now day one, you want to build a portfolio. Okay, so what do you do? First thing you do is to look at the climate. So the climate is telling you what? The climate is telling you close is below the average. Okay, DMI is blue. So what does that mean? Contradiction. That means we have a contradiction. So if I have a contradiction, it means that I have an unconfirmed climate, and therefore I want a portfolio with 50-50 exposure. That's what I want. Okay, 50-50 exposure, that's what I want. So in other words, I will want to look at directional trades to the long side, and I will want to look at directional trades to the short side, and I would want to have both of those trades in place. Okay, now those trades will have a different delta exposure. Okay, those trades will have a different delta exposure, will carry a different level of risk. Okay, they will have a different delta exposure, they will carry a different level of risk. Okay, and but they will both provide positive gamma. No matter if I do call trades or I do put trades, they will both provide positive gamma. Okay, which is one easy rule to meet. Okay, as long as I keep adding directional trades, I will keep increasing my positive gamma. Okay, so let me grab a brand new spreadsheet. Okay, here's a spreadsheet. Okay, and we're gonna start looking at those trades. So let's begin with planning trade number one. Okay, let's begin planning trade number one, and let's see where we go with this. Okay, so we are planning trade number one. So I'll begin with the longs. Okay, I'll do like what we do on Thursday at the speed of the light. Okay, so let's say I'm looking at Adobe. Okay, and as I just said, you would look at the market condition of Adobe. So Adobe has the close is 306.87, which is above the average, right? The DMI is blue, so you have a confirmed climate for Adobe, right? So you want to go long. For you to go long, you need to find green UFOs. Okay. Well, we don't have green UFOs around 306, at least in the current session, which is regular session. So we'll look at the pre and post market in a minute. Okay. Fortunately, it's going to take a while to load. I noticed that since the few past days, at least being located in Asia, I'm having a very slow speed coming from TradeStation to give me market data. So I need to talk to them on Monday, first thing in the morning, US time. So I'm just clicking on all the symbols so the data begins downloading. So that way, when possible, it'll be ready. I'm just realizing I should have done that before the session. But anyway, so Adobe. Here we go. Here's Adobe. So 304.60. Okay, that gives you 46%. If I switch to pre and post market, that gives you. Okay, and by the way, I don't need the CCI anymore. Okay, the CCI is not to be used with Adobe. It's only to be used with your guide. Okay, and remember the guide for the portfolio. I am using the S&P for the guide. Okay, so and by the way, I didn't even need to use the CCI because I already concluded the climate is unconfirmed. Okay, so no need to use the CCI. So what do we have? Okay, well, we have 46%. Well, that's not good enough for a directional trade. As you know from the third session, we need 50%. Okay, so that's not a good one, but I'm going to pretend for the example that it's a good one, and I'm going to pretend as well, just to make the example shorter in time. I'm also going to pretend that we have a green UFO right here. Okay, and therefore Adobe is inside the green UFO, and therefore it's time to take the trade. Okay, so let's pretend that's what we have. So what would you do? Well, you would set your target. Okay, you would set your target. I'm not going to do the whole thing because you know the process. So you will look at the weekly time frame of Adobe. You would turn on your beautiful AutoUFOs, look for the red UFO, and once you know the red UFO, let's say the target is 315, so you would go for the trade. Okay, so to go for the trade, you would load the option chain with Adobe. You would calculate the time to target. Okay, I'm not gonna do it to save time. Let's pretend time to target and earnings is September. So I'm gonna use September, which is 61 days from now. And because the target is 315, so I will right click on Analyze by Vertical. So I can get this here on my Analysis tab, so I can plan the trade. Orlando, this is advanced and complex. Not many investors know these principles and rules. Portfolio risk management, excellent, Jose. Thank you so much, Orlando. It is indeed, this is hedge fund management. This is how you manage a hedge fund. Okay, so this is obviously advanced. This is not, average investors don't do any of this. Okay, so yeah. So anyway, so we are gonna go ahead and use 315 for the target, right? So you would sell the 315 call for the target. Okay, I'm gonna go ahead and say that the current price, which is normally not the case, right? But to make it simple for today's example, I'm gonna go ahead and say that the last price is the entry price because we are inside the virtual UFO I just drawn a minute ago. So let's say this is our entry price, I mean the price of the stock. And therefore, we are now gaining from this trade. If I sell the 315 and I buy the 300, we are gaining 18 deltas. Well, you know that we have a rule when building positions, we want deltas to be around 30 or 30 something, right? So I would probably need to use, actually I would need to use something around the 305. And if I use the 305, 315, my delta is even less, is 12, which means that my 315 is too close. So I'm just doing what I would do any Thursday. That's why I'm doing it quick. So I will move this to 320. My delta is still not 30. I will move to 325. My delta is now 24. I'm getting close. Probably one more change will do it. 330. That's it. 29.58. I'll call it good enough. Okay. And you know, that's it. Okay, so 305, 330, this is gonna be the trade. So what would you do now? Well, now you come to your spreadsheet and you would say, okay, well, if I do this trade, okay, and you may have a column here for description. So this trade is going to be a bull call spread using September 20 expiration, and it's going to be the 305, 330 call. Okay, this is going to be the type of trade that you are entering in your account in that particular case. Okay, so that would be trade number one. Now, if I do trade number one like that, okay, if I do trade number one like that, okay, so the question is, what outcome this trade has? And the first thing that we need to add here is the risk. So how much is the cost of this trade? Well, the cost of this trade is 10.3. Okay, 10.3 times 100, okay, that is going to be $1,030 of risk. So this is the risk of this trade. Okay, now, of course, big picture, you have your account balance, right? So big picture, you have your account balance, right? So what is your account balance? Okay, well, let's say your account balance is $100,000. Okay, so let's say this is your account balance. How much is 6% risk? Okay, so how much is 6% risk? Well, 6% risk would be that number times 6%, which is $6,000. So what you're saying here is that, okay, I'm happy to add up to $6,000 of risk. This trade is adding 1,000. Okay, so available risk. Okay, available risk. Okay, could be a calculation that you do somewhere in the spreadsheet where you're gonna have somewhere here total risk that will measure all the risk coming from all the trades that you have. Okay, up to this point, we only have one trade. We are building the portfolio from the beginning, so we have 1,000. So the available risk would be the maximum risk you want to take minus the risk that the portfolio is assuming at this moment in time. So you can still take other trades to add up to $4,970 of risk. Okay, so Subhash, per trade, you're talking about 3%. So per trade, you can make that number higher or lesser. My suggestion would be to make it much lesser, because the smaller you make it, like for example, let's say you are willing to risk 0.5% per trade. If you are willing to risk 0.5% per trade, that will allow you to have many more trades running in your portfolio. Instead of only one trade, okay, instead of trade 1 to 6, right? If you risk 1%, you can run up to 6 trades at the same time. But if you risk if you risk 0.5% per trade, then that will allow you to have 12 trades running at the same time. And the more trades you run at the same time, in one hand, it's more tedious to manage, but in the other hand, it gives you more flexibility. So it depends on your account size. It depends on how active you want to be. It depends on multiple factors on how you want to manage your portfolio. Okay, but just keep that in mind, that your 3% value would allow you to run maximum 4 trades. 4 times 3, maximum 2 trades, correct? Because 2 times 3 is 6% already. So you could only have 1 long, 1 short, and then you could not do non-directional. Okay, because that would be too much risk. Okay, so I would suggest to use much smaller figures. Okay, of course that becomes complicated if your account is of a smaller size. But let's face it, if the account is of a smaller size, well, maybe instead of doing long-term management of a portfolio, you should do short-term trading and be in and out of trades on a high leverage scenario to create a faster speed of profitability. So you build capital, and one day you have a bigger size capital to manage a portfolio, if that was your case, okay, which everybody, of course, in the group is different. Okay. So anyway, let's continue. What else do we have? Well, we need to look at the delta, we need to look at the gamma, and we need to look at the theta. Okay, we need to look at all those guys. Okay, so let me see, just to make this a little more friendly. So I'll make all of these 1543 is a little bit of a mess right now. So now all the columns are of the same size. Okay, and now we are looking at those three guys. Okay, there is the delta and the gamma. So what is the delta that you get? Well, the delta you get is 2958. Okay, so you get 29.58. So what is the gamma that you get? You get 0.15. Okay, what is the theta that you get? The theta is negative 3.51. Okay, negative 3.51. Now, here's the thing. The risk, that's a figure that will stay constant until the end of the trade unless you do damage control and therefore you reconvert this trade into something else. Like, for example, shorting shares against the bull call spread. Okay, or doing, converting an iron condor into an iron butterfly, like we covered. So if you do some sort of a change, an evolution of the position, then of course the risk will change. If you do nothing, then that column will stay the same. Now that column will stay the same, but the delta, gamma, and theta will change every day. So to manage your portfolio, you will need to re-update delta, gamma, and theta every day. Okay, and what's going to happen is that if the stock is moving your way, your delta will be more every day. If time passes and the stock moves in your way, then the gamma will also change. It will change to be a greater value, and also the theta will also become a greater negative value. Okay, as time passes. So all those things are going to be changing, and in order to reposition, readjust the portfolio on a regular basis, you want to make sure that you are looking at this in a regular basis. Okay. So let's say you are happy with the trade and you execute the trade. Now you have that particular risk in your portfolio, okay, and you got 29 delta. But wait a minute, we said we are earlier when I looked at the S&P, right? When we looked at the S&P earlier, what did we say? We said that we were in a unconfirmed climate. So in an unconfirmed climate, what do you want? You want 50-50 delta. So if you want 50-50 delta, what do you have to do now? Well, you're going to have to go ahead and look at the delta you have in the portfolio. Okay. Okay. Look at the delta you have on the portfolio. The portfolio right now has a total of positive 30. Actually, I don't want this to be. Let me do it like that. Here we go. I got 29 delta. So how do I end up having 50-50? Well, I need negative 29.58. If I find something that gives me negative 29.58, then my net delta becomes zero because I am in an unconfirmed, climate. So I want the delta to be zero because basically I ended up with 50-50. Now, if I was to be in a confirmed market condition, so what you would do is that you would want to add deltas, okay, in a way where, for example, if I do minus 15 delta or something like that, okay, if I do minus 15 delta, you are still net positive delta for the overall portfolio, and this would be, if you add the whole thing, let me get a calculator. So I'm going to call it 30 instead of 29 out of simplicity. So 30 plus 15, that's 45, isn't it? So 45 is the total available delta as an absolute value, right? So 30 out of 45, that is 66%, right? So I would have 66% of my delta is positive and 15 negative, okay? So 15 delta negative out of a total of deltas of 45, that's 33% delta exposure, okay? So you could certainly come up here with positive deltas. I just create a easy formula, negative deltas. Okay, you can create a little bit of a formula. Positive deltas percent, negative deltas percent. Oh, sorry. Okay, and what you could do is you can just sum. You can sum if, and there are different ways on how to do this. Okay, again, this is not a spreadsheet course, an Excel course, but anyway. So sum all of these if it's greater than 0. Okay, so this is greater than 0. So that is 2958. Okay, and I can also sum, okay, because it's negative, instead of plus I will make it minus, sum the ones that are less than 0. Okay, so the total delta available is this. Okay, so what you would do is you would just take the positive. Okay, so the positive divided by the total absolute value of deltas, and that is 66%. Okay, I'll give it a couple of decimal places, and the same, you can do the same for the negative. Well, actually it's even easier to do this, so you can do 1 minus this. Here we go, and now you got the negative, right? So now you can see your delta exposure. So if you add a position which is minus 10, well, it's not enough. I need another position that is maybe minus 5, and now I got my delta exposure 60-33 if I am in a confirmed market position, or maybe I get minus 10 and then I get minus 19, and now I got my 50-50 delta exposure. Okay, guys? And by the way, even though this spreadsheet is kind of improvised, if you like it, feel free to send an email, and I'm more than happy to send it to you. If doing spreadsheet formulas is not your strength, you know, you can use this one. Okay, so I'm just gonna save it. Well, I'll save it before the end of the session. So now let's say you want to build you want to find a short. So Netflix, it's way too far away from the UFOs. So ABBV, let's see what we have. I remember we planned a trade with Len that we didn't get filled yet, isn't it? We did that on Thursday, so I'll do the same. I'll go back to Len. So with Len, I believe we were using regular session. Okay, so we did plan on a bear put. You see, I got the notes here from the other day. The average now is 47. So we got the UFO. So let's say you plan a trade using that UFO, and let's say this trade end up having you use. I'm just gonna make it up out of using little of our time. So we have Len, okay, we had the 47 and 40, okay, and let's say I'm going to use this one, okay, which is the one I did on Thursday. So if I was to do this one, this trade would cost me 258. This is the cost of the trade. So what is my maximum risk? 258. Okay, I still got more money I can risk. Okay, I still got more money I can risk. So 258. This was a bear put spread using November 15, using I forgot, I think it was 47 and something. Let me see, 47.5 and 40. So 47.5 and 40, that's your bear put spread, and it would cost you 258. The delta, as you can see at the entry point, this is the entry point, 47.38. That was the UFO we identified on Thursday. So I'm just going to leave it like that, what we did on Thursday. So that's going to be a delta of minus 31.21. So your delta will be minus 31.21. So is the delta exposure okay? Well, in a perfect world, you will want 50-50. In the real world, I think it's okay for us to say it's good enough, because realistically 50-50 is not going to be possible. Plus, remember, the Greeks change every day, so this is going to be moving a little bit around. Okay, so I'll say it's good enough. From a gamma point of view, I got 2.6. So I got 2.6, okay? And from a theta point of view, we got negative 0.34. So negative 0.34. So that would be the trade that we have. So what do we have? Okay, well, we have $1,200 of risk. We still got 4,000 of risk available. We have the delta the way we want. We have the gamma is positive. That's what we want. The gamma is positive. Okay, that's what we want as well. Okay, and then the theta would love it to be positive. Is not. Okay, is not. So we are not too happy about that, even though there is nothing to complain about because it's what it is. Okay, but maybe we can help. Maybe we can find a non-directional trade because I got plenty of positive gamma. So if I find a non-directional trade with some negative gamma, maybe -2, well, if I find something with -2, it still leaves me as positive gamma overall, correct? If the delta is not too big, let's say is 5, you know, my allocation with deltas is still close to 50-50, right? And if I was to find a non-directional trade, which of course pays theta, maybe I find a trade that pays me 2.5. So then, yeah, my theta is still negative, but it's much less negative now. So now we will be making money on time decay, where I got my gamma, and then my deltas are exposed the way I should based on the market climate. You guys with me on that? Give me some confirmation, please. Okay, so we're gonna go ahead and find a non-directional trade. Okay, and it could be purely non-directional, or it could be a bull call spread and a bull put spread, or something like that. It could from two different stocks. Maka, I lost you there. Would you mind to be a little more precise when you mean there? Because I'm happy to repeat or point at it again. Yes, D-high, and this will be useful, okay? I mean, guys, some of the sessions that we are covering over the weekend, they have pretty advanced content, okay? And we keep growing together, okay? And there is much more to grow. But certainly this is not a basic session, okay? So it's always healthy before you put your money at risk that you rewatch it, okay? It was with the total deltas. Okay, got it, Maka. So what I'll do is, let me look for a non-directional trade, okay? And as I put it together, I'll go back to the spreadsheet and I will be pointing at the deltas and going over this again, okay? Beta weighting the portfolio. Well, beta weighting the portfolio actually also means to, when you select the stocks, to me, and again, before I explain that, I'll share you my opinion about it. I think that beta weighting sometimes forces you to use stocks that maybe you should not. So I'm not a fan of beta weighting, but basically beta weighting would mean that all those stocks that we have in our lists, okay, especially for directional, okay, for directional, all those stocks, they are outperforming the market when going long and underperforming the market when going short. So then you are adding some sort of a relative performance type of advantage when it comes to your stock selection. The problem is that what beta measurements don't measure is where are the UFOs. That's the problem. And sometimes you have a stock that is behaving very weak compared to the market. And the reason why it behaves very weak is because there are many green UFOs. And that's why it's behaving, there are many red UFOs. That's why it's behaving weak. The market cannot go up easily because there are many red UFOs. That's why it's weak. But maybe there is only one UFO left. So even though it was behaving very weak, it's about to start behaving very strong because there is only one UFO left. Isn't it? So those beta calculations don't take that into consideration. Okay. So in this case, I would just ignore beta measurements. Cool. So anyway, so non-directional. Okay. So let's say I'm just gonna pick something here. What do we have? Well, I know from the other day that PayPal is not a good candidate. or look at Apple. Come on, let's look at Apple. Again, normally what we do on Thursday when we look at non-directional, the first thing we do, isn't it? It's to make sure, and this is imperative, make sure that earnings are not happening anywhere in between the life of the trade. Okay, so I'm not gonna check on Apple when the earnings are, because I just want to do this quickly. So this is probably not a valid trade. I'm just gonna pretend it's valid just to be efficient with rushing into the final part of the explanation, because we are supposed to finalize this session in 7 minutes. Okay, so again, today is not a trading day, even though of course I love, if possible, to kill two birds on one stone, give you a theoretical explanation and give you a good trade at the same time. I love it, but today is sharpening, so the priority will be the session. Okay, so what do we have here? So we have 59% with Apple. 59% with Apple. Let me see. Do we have more UFOs above and below? Yes, we do. Okay, so let's say you were to do an iron condor, and the iron condor you were to do was to use, well, that's very far away. Let me see. In regular session, that's 59. With regular session, we have 46. Yes, certainly with Apple, we need to use pre and post market. I'm just trying to do something more realistic, but you know what? Let's do something. Let's do something. So this is certainly not going to be a good trade, okay? But it's going to be a good example. You'll see why. So let's pretend 206 is the top. Let's pretend 201 is the bottom, which is not a good idea, because notice how the current price is very close to the bottom, right? So if you apply the methodology we use to do iron condors, where we calculate 1 standard deviation above and below, this trade would never be planned this way, isn't it? But for a minute, let's pretend you have done this trade a few days ago, when Apple was somewhere in the middle, okay, and you have done that, and you have an iron condor. Let me add it here, Apple. Okay, so you have an iron condor using, we're gonna use July 26, analyze sell, iron condor, and the iron condor we're gonna have is gonna be 08. We don't have 08, okay, so we're gonna do 210, 207.5, and then we're gonna do 200 and 197.5. Okay, so let's say that was the condor, and I know I'm doing this at the speed of the light. It's okay. You can see the shape. Okay, you can see the shape. Okay, so between those price levels, you are fine. Okay, and when you look at this condor at current price, this condor, okay, to make this simple, I'm gonna remove everything. I'm only leaving the last. Okay, so a few days ago when you planned this trade, it would not be like that. Okay, but today you have a delta of 3.3. Okay, so 3.3 on this trade. Your gamma is negative 3.90. Negative 3.90. Okay, your theta is 8.22. Okay, and the risk of the trade is the distance between strikes, which is 250, correct? 250, and minus the credit collected. Today is 80 cents. Let's say you did that a couple of days ago. So let's say it was 100. Okay, so if the maximum you can lose is 2.5, but you got paid 1, so the maximum you can lose is 150. Okay, so the condor is giving you $150 of risk. Okay, so that's an iron condor. Iron condor using July 26, and that would be using we said 202.5, I think it was, right? No, 210, sorry guys, 210, 207.5, and then on the put side we said to use the 200 and the 197.5. Okay, so that would be the trade. Okay, that would be your trade. with the iron condor? Well, if you do this trade, it's great because now you ended up with a positive theta. Your deltas are still more or less okay. Not exactly 50-50, but it's more or less okay. But now what's the problem? Now your gamma is negative. Okay? Your gamma is negative, so that is not making you happy. Okay? So what's the only way to get positive gamma? Well, given the fact that it's okay for you to take more risk, because you still got cushion available, you will need to add more. Okay? You will need to add more. You will need to add more gamma by doing another trade. So what will you do? You will go back to your directional, positive and negative, right? Bullish and bearish. Maybe you look at Schwab, for example. So let's see if we got a trade there. So 41.20. So 41.20 is falling into this one. So let's say you did a trade here with Schwab. So, and I'm just going to make it up, okay? Because we have no time. So you would do a trade with Schwab. You would do a bull call spread. Okay, whatever the spread was. Let's say that would have a risk of 750. Okay, and that would provide a delta of positive 32 and a gamma of positive 1 and a theta of negative 2.2. Okay, so what would be the situation now? Well, now you have a problem because your delta is 67.32, and given the market climate, you want it to be 50. Right? So you need a short. The good news though is that your gamma is almost positive now. So I have two good news in a row. Good news number one, we almost made our gamma positive. Good news number two, okay, because my delta are leaning too much towards the positive, I need negative gamma. Well, how do I get negative gamma? I'll need to find a bear put spread. And to find a bear put spread, okay, which I will do with my stocks from the short list, okay, to find a bear put spread, I will need to do that debit trade, which is going to create another payment for me, which it's fine because I still got available risk. So let's say 630, and that's going to produce, let's say it produces negative 35. Okay, so that is giving me my 50-50. Okay, and now this is going to produce, maybe it produces another 1.1 gamma. So now my gamma is positive, and now this may produces negative 1.8. Okay, which overall, oh my god, amazing. I got the positive theta, the positive gamma, and the 50-50 delta. Okay, and tomorrow I'll look at my guide again. So tomorrow I will look at the S&P on the chart, look to see if I am in a confirmed climate or unconfirmed climate or risky climate, okay? And depending on that, decide on my deltas. And I may need to add a new long or I may need to add a new short, okay? And make sure it gives me the positive gamma impact. If not, add more positions to get the positive gamma. And ideally, theta is positive, which may not always be the case. So, the lesson is over, my friends. I have a few questions from Maka from the very beginning, so I want to take care of those questions. But again, this was a little advanced. I mean, this is powerful, guys. Okay, let's get serious now. I mean, I've been serious all the time, okay? But now, really, this is impactful, okay? You manage a portfolio that way, and you're always with the market. You are diversified in the form of strategies. Some strategies pay you time, some strategies don't. Some strategies are hedging, some strategies are not. Some strategies are, also when you combine with damage control, right? So you lock on some profits by hedging the way we covered, right? With the gamma hedge. So anyway, all these things is like almost like little particles in different places in your portfolio that keep producing certain types of different benefits that added all together ultimately produces consistency. Okay? And even though it's all equities, you are diversified amazingly well. Okay? You are diversified. Everything looks good on my side. The height for the sound. Is everybody with me on the sound? So would it be a good idea if you don't max out your risk in case you need to add positions based on market change? Yeah, so what you would do is to always have a little bit of availability for a little extra. Okay, it's just like companies, you always have a little hidden budget. Okay, hidden budget that if needed you will use it. In normal cases you don't want to use it. You don't even want the employees of that company to know that budget exists, but top directors of that company will know that in case it's needed, there is a little extra budget somewhere, right? So, one healthy way to look at it is, instead of making your risk to be 6%, just make it 5%, and you have that extra 1% that if you need an extra position or two, you can put it in the account thanks to that additional extra little budget, that extra 1%. Cool. So it seems that you guys are fine. So I'll go back to the very beginning of the chat where Maka was posting a couple of questions at the beginning of the session. And again, Maka has two questions which we could spend 2 hours to answer each question, or we can just keep it very simple and go straight to the point. Okay, so I'll do that, Maka. And if you feel that my answers are not complete enough, we can certainly have another session. Maybe we can make it just for that purpose, okay? Because again, your question can be, that subject can be very dense, okay? So the first question from Maka is, your plans to include other trading platforms in your sessions in addition to TradeStation, okay? So, and the reason why Maka is asking is because she is also interested in understanding the pros and the cons of different brokers, different platforms, and so on. So first of all, I will say that, and this is my belief, okay, so this is something personal, but to me, TradeStation is probably the best platform in the world. So therefore, you will see a lot of TradeStation in the sessions, and probably even more than what we do now, okay, because there is a lot of stuff in TradeStation that we can do that I have never showed, and there are many things that we can keep stretching the power of TradeStation to much more efficient levels, okay? Like the spreadsheet I just built, but it's all inside TradeStation. All those things can be done, okay? So we'll keep working on that, and there is a lot of more TradeStation stuff to come. Now, like all brokers, like all softwares, everything got pros and cons. So from a software point of view, you may be in a place in the world where you cannot get TradeStation. There are certain countries that where TradeStation is simply not available, just based on the regulations of that country, or based on certain business decisions of TradeStation itself. So there are times where you may not be able to have TradeStation, and if that's the case, even though TradeStation is great, then it's not great for you, right? Other cases that may happen, and these could happen with all brokers, TradeStation and others, which is that sometimes you have a bad experience with a customer representative, and even though TradeStation is great, next thing you know, you're like, you know what, I'm not happy with TradeStation, I'm going to switch broker because this guy didn't treat me well, this guy didn't give me the right answers, and I'm not happy with TradeStation, so I'm just going to move to a different broker. So, that could happen too. Okay, so I know there are many of you in the sessions that don't use TradeStation. I would certainly encourage you to use TradeStation because it's great. You may even know, I said that in prior sessions, that we actually, to make your life a little easier as a UFO trader, we have created a special link. So if you use tradewithufos /TradeStation, okay, so tradewithufos, okay, so you type www.tradewithufos.com /TradeStation. TradeStation. If you type that, okay, let me do that again because I did it too quick. Tradewithufos /TradeStation. Okay, if you type this, okay, this, you hit enter, and that will bring you to a page where this is where you register a new account. And the reason why or register a new account for new customers or existing customers. So the reason why we created that link is because the moment you click in this link, notice that here you got this very nice guy, Bradley Grace, that is assigned to us as a company, and this guy is located physically in Chicago. He's a great guy. If you ever have any problem with TradeStation, he can help you. You can contact us. We can share with you his contact information. So if you were to ever have a problem with your customer representative, which, let's face it, it happens with all big companies, just like when you call your bank or an airline. So it could happen that sometimes you got a person on the phone that is not perfectly trained, and that could happen. It's real life. So, this guy could help you. Okay, so quick tip, www.tradewithufos.com/TradeStation. Okay, that would be your tip. If you don't use TradeStation, of course, our recommendation is that you use TradingView. That's why we also have created the TradingView link, same story, to bring you to the right place in TradingView. Okay, so it's the same URL. So you begin with tradewithufos.com/TradingView. It's kind of the same nomenclature I used earlier with TradeStation, but now it's TradingView. And that way you get TradingView. And by getting TradingView, now you have the UFOs. Of course, everything that we do is to support you with the use of the UFOs, and therefore our bread and butter, coming back to brokers, is going to be either TradeStation or via TradingView. Okay, this is something that many of you may not know. Okay, and maybe I should have said that better or more or before, or I don't know. But when you open TradingView, okay, when you open TradingView, which many of you may think of TradingView as a charting tool, it's not only a charting tool. Okay, you can connect, okay, to CQG. So CQG is a professional trading platform for futures and options on futures that is given to you by professional futures brokers. So you open an account with a professional futures broker from Chicago. Typically, this is where the best futures brokers are in the US, at least. They will give you a CQG account. If, let's say you are in Singapore and you are working with KGI, you are working with Phillips Capital, those major companies that are professional futures brokers, they will give you access to CQG. So you could connect your CQG credentials to TradingView, and now you have the UFOs, but you trade from TradingView. And you have the DOM, you have the possibility to use bracket orders. Everything you need is there, guys. Okay, so you can trade with TradingView. You can also connect to AMP. For Forex, you have Oanda. Recently, they added Tradovate. By the way, there is a deal between TradingView and TradeStation. It's not active yet, but it's going to be soon, where you could execute via TradeStation from TradingView. Okay, and more brokers to come, which I'm not allowed to reveal because of non-disclosure agreements with TradingView in this case, but I am telling you that some of the brokers that some of you use, okay, Maca, you know what I'm talking about, will be available within TradingView as well for you to trade from here. Okay, so all those things are available. So bread and butter when it comes to brokers and charting and software and packages and all that stuff, it's gonna be TradeStation and TradingView, and this is gonna be our bread and butter, because with these two guys, basically you have everything you need. You have the market replay with TradingView as well, and then of course with TradingView you also have cryptocurrencies, international markets, all the commodities, the stocks in China, Taiwan, and Germany, and Spain, and Mexico, and Brazil, and Canada, and you name it. So it's all in here, and by far it's the most convenient combination, TradeStation and TradingView, apart from the robustness when it comes to functionality and the technology they use. Okay, so that's why we are focusing on those two guys. Again, I am aware that some of you are using other brokers, so I would like to mention a few extra names because if in your country, as I said, let's say TradeStation is not available, or for whatever reason you're like, yeah, I don't want TradeStation, I use TradingView to do my UFO, and then I'll execute with another broker because of a different reason, or maybe because of diversification, because maybe you manage a sum of money which is significant enough for you to not to focus on one broker only, okay? Or because you not only trade your own money, maybe you trade your own money, but you also trade your family members. So how can you make your life easier for that? Okay, well, then you can use brokers such as interactive brokers or thinkorswim. Those are, well, thinkorswim, the technical name actually is TD Ameritrade. Could be TD Ameritrade in Singapore, could be TD Ameritrade in the US. Those brokers are valid as well. Especially, I would say, interactive brokers has a very nice feature, which is the fact that you can open a friends and family account, or if you do it professionally, it's called an advisor account. And with those accounts, basically, you can link a master account with slave accounts. So you get power of attorney on the slave accounts. That could be your mom, your sister, your brother-in-law, and then you have your master account, which is yours. And then you connect the master account with the slave accounts. So what happens is that every time you take a trade on your account, automatically the trades replicate in the slave accounts with a different level of allocation, which is set up by you. Okay, for example, if your account is 10 times the size of your mom, so then your mom will have the same trades as you, but the size will be 10 times less. Okay, and this could be all automated. It's not 100% straightforward. There is some stuff to be done to have it all set up. It's actually a little complex because it's quite professional, so therefore it comes with a little complexity, but it's worth it and it's very powerful. Okay, guys? And then with thinkorswim, I would say probably the best reputation of thinkorswim, and they deserve it, is all the options analytics tools are really, really cool. Okay, now I would also say the charting capabilities are very, very limited, okay, compared to TradeStation. Even TradingView is more advanced with charting than thinkorswim. Again, those are personal opinions, okay, so you may or you may not agree with me, and it's certainly fine. Okay, so basically, to answer Maka's question, the goals I have in the session, which is what you have seen in the past, is I will be using TradeStation most of the time and TradingView most of the time, and from time to time I will be flashing TOS, which I have, and so from time to time I will be flashing IB, interactive brokers, which I have. Okay, another platform I will add into the sessions is MetaTrader 4. Okay, so this is something I have not done yet, and I will, just like at the moment the short-term sessions that we do on Tuesday I only trade the S&P and the Nasdaq. Well, I will need to add more markets there, isn't it? The gold, the crude oil, the natural gas. So we'll need to add markets, we'll need to add platforms, and this will happen as we add more sessions. Because what we could not do is to add, how do I put it? Like one session where in 1 hour I display 5 different platforms, that would be more confusing than helpful. Okay, so we need to also find the balance, okay, and therefore we'll be using a little bit of everything. Okay, now I have to say that MetaTrader 4 will be used, at least for now, for execution purposes only, not for the charting, because just like I said, the charting available on TOS is weak compared to TradeStation or TradingView. Well, the charting available on MetaTrader 4 it's I would say even more weak, and on top of that, with most forex brokers or CFD brokers, normally you have a lot of limitations when it comes to historical data, unless you download files manually and you upload them into MetaTrader, and it's a little bit of a pain. So why would you do that? TradingView is for free, so let's use TradingView for the charting if you are not using TradeStation, and then you can do your execution with other platforms. Okay, so I will be combining a little bit of everything, and in the end, you also need to add your personal flavor, where all of us are different. And you may tell me, but you know what, Jose, I do love MT4, and I say, you know what, I respect that opinion. Okay, and then I can see that you are using MT4, and it's fine. Okay, but again, now you understand. Hopefully, you understand a little better the rationale behind the decisions that I will be having in the sessions. Okay, guys. The next question from Maka has to do with taxes. Okay, and I'm going to talk about that right now. But let me take a look at Bojan. Jose, if you have the chance, can you go over the management of the STZ trade, or do we just wait until October 3rd to exit? Good. So I'll look at that after I answer the tax question. Okay. So first of all, before I answer anything related to taxes, and this is not a disclaimer, but at the same time it is a disclaimer, you all need to understand I am not a tax expert, and on top of that, different jurisdictions, different countries have different tax rules, and obviously it's impossible for me to be aware of everything, especially given the fact that those laws are changing. Okay, so advice number one for everybody is that make sure you find a good tax person, most importantly a person who understands traders, that have customers that are traders, so they understand the tax law for traders, which in some countries are very simple, in some countries are very crazy complicated. Okay, for example, in Singapore, taxes for trading are 0. There is no tax for capital gains. So it doesn't matter if I use a margin account or a cash account or a futures account or a forex account or an options account. I don't care. I don't pay taxes. So this is the type of places where you want to find. Okay, so my recommendation is find places like that where to trade. It doesn't mean, I'm not saying move away from your country, change your passport and go there. That's not what I'm saying, because of course that sometimes may be doable, sometimes may not be doable, sometimes it may be your wish, sometimes it may not be your wish, and of course it's all to be respected. So, but what you need to know is that when it comes to trading, you could trade under your name, but you can also trade under company or entity names. So you could be a person who resides, for example, in the UK, to pick a place, but you may own a company in Estonia, which international profits are tax-free in Estonia. So maybe you have a company in Estonia that opens a trading account in the US, makes profits. Profits are drawn into Estonia. They are international profits, so they are exempt of taxes, and therefore your company doesn't pay taxes. Okay, now, different story is when you bring that money from Estonia back into you as a person in the UK, then you would need to look at the UK law, and for sure you would need to pay some taxes there. Okay, so again, every case is different. I mean, there is how far I can read, and the tax code is so deep in some countries. So make sure you document yourself properly, but at the same time, keep in mind that one of the benefits of trading is that you don't need vehicles, you don't need warehouses, you don't need offices. In other words, your business can be quite mobile, and therefore you can benefit from tax advantages, which are worldwide tax advantages. And I don't mean to do anything, sorry for the word, I'm going to use a word that is not too polite. I don't mean you guys to do anything dodgy, okay? I mean, it's not like my words was that impolite, but you get my point, okay? So let's do things properly done, be properly documented, and do everything correct to the point. And just do stuff professionally, okay, and that's it. But keep an open mind to the tax systems in the world, and therefore find a powerful tax guy. Now, if you don't want to make your life too complicated, as a rule of thumb, I will say that in most countries that do tax capital gains, such as most countries in Europe, US, Canada, and many other countries, okay? Typically in those countries where capital gains are taxable, typically you have two types of accounts that you can open with your brokers. The accounts that are cash and the accounts that are margin. So for example, you can open a stock account, which is a margin account, or you can open a stock account, which is cash. Certain products are always margin. For example, a futures account will always be margin. Okay, and in those countries where capital gains are taxable, first rule that is always the case, or almost always the case, is that margin accounts are taxable accounts. So if you trade futures, you trade forex, you trade stocks on margin, you will pay taxes. And in most cases, those taxes will be paid at a rate of income tax. That's what normally happens. So it's like a job. If you have a job and you made $1 million, you will pay X amount of money. So if you trade it on margin and you made $1 million, you would pay the same amount of money in taxes that you would pay if you had made $1 million from a job. This is the case in most of the cases in the countries where capital gains are taxable. For example, in the US, futures have some benefits. Okay, you would have like you don't pay 100% income for the futures trades. So you have some benefits, but I cannot get into details because I may not be 100% accurate. And again, you need a tax expert for that. Okay. I'm just giving you basic rules and guides if you wish. Okay. So now, when it comes to the cash accounts, so again, back to the countries where capital gains are taxable. In the countries where capital gains are taxable, you often find two types of cash accounts. The cash accounts that are taxable and the cash accounts which are tax deferred. So taxable means that is the same as margin. You pay taxes for the profits made. It's the same thing. The whole thing is the same, but you got no margin, you got no leverage, and therefore you need more money for your trades. That's all. So basically, this would only be used by a person who is very conservative and doesn't want to assume additional risk and doesn't want to short, things like that. And you would be like, okay, I'm going to use a cash account. So for you guys, probably you would not be interested in that because you want to spice it up with margin. I would say that's the case in your case. But the tax deferred could be an advantage at times. Again, you need a tax expert to confirm that to you. But tax deferred means that you will not pay taxes until the day you retire. So you trade, make profits. You are not being taxed now until the day you officially retire, and then you will be taxed on the money you take out of the account. You don't get taxed on the account money, but you get taxed the moment you take money out of the account. This is what is called a tax deferred model, which happens to be in many countries. Like for example, in the UK, again, I'm not an expert, guys, okay, but I believe, if I'm not mistaken, you got SIP accounts in the UK. So SIP accounts, the I is for investment, so meaning long-term, meaning retirement. The P is actually for pension, which is how retirement plans are normally referred to as in the UK and many places in Europe, pensions. In the US, for example, they don't talk about pensions, they talk about retirement. It's a different concept, okay, different country, different terminology, but it's the same thing. So you have something called IRA accounts, totally different meaning than what IRA means in the UK, of course, not even a funny joke. But IRA in the UK, in the US, the R is for retirement and the A is for account. So that's an account where you have your taxes deferred. It's a cash account where you have certain tax advantages. So again, when you open an account with a broker, you want to first, it's kind of all together, right? It's like you want to use the right broker and the right account with the broker. Because what the broker will give you is access to an account and access to a software. So you want to make sure the software provided by the broker makes you happy, let's say TradeStation, and you want to make sure the account you set up with that broker is the right account that gives you the tax benefits that you want. Okay? So you need to ask yourself, do I want my taxes to be deferred? Am I okay paying taxes? Do I want leverage? I don't want leverage. Of course, you also need to wonder about the ownership of the account. I think that this is not Maka's question, but I'm going to add it. Okay, the account could be an individual account. The account could be joint, which means it's not only yours. It could be yours and your spouse, for example. So it's a joint account. Or the account is a corporate account, right? So it's not an individual, it's an entity. Okay, so, and it's all linked because you may have set up an entity in some country. Maybe you live in, I don't know, maybe you live in Thailand, which I'm not sure about the tax rate in Thailand, but you are like, you know what, I'm going to set up an account in the neighbor country, which is Malaysia, because capital gains are exempt of tax, right? And so what do? You set up a company in Malaysia, and now you are, even though you live in Thailand, you have a corporate account. It's not individual, it's a corporate account, because the corporation you set up is in Malaysia, is a Malaysian entity. So you have a corporate account who owns a margin account with the broker TradeStation that gives you access to the software. Okay, so in the end, those three components are linked. Corporate, individual, or joint, so the ownership of the account, together with taxable or not, which is related to margin or not, okay, and then which broker, which basically has a lot to do with the software you use to trade, okay, which is a personal preference, okay, and obviously it's also a functionality preference, okay. In your case, I am pretty positive that, you know, having access to the UFOs, of course, makes a difference to you guys, and therefore you have the UFOs with TradeStation and TradingView, and therefore that's one reason that makes those two platforms likely going to be your favorite. Okay, but it may not be the case, or it may be the case that you also use multiple brokers for diversification. So you do have a TradeStation account, okay, and then you use IB and TOS. All right. Well, I'm going to add one more, and that's going to be the last. And this is not to drive you crazy, just because there are many choices. You may set up an account with TradeStation just so you have TradeStation, and you execute everything with a different broker. That could be too. Okay, so you have with TradeStation you open an account, you have no maintenance fee, you have free data feeds for all markets, options, futures, currency, stocks. Okay, and as long as you got $500 in the account, you get access, you get market data for these, right? And then you got your UFOs, right? And then maybe you use TradeStation to do your analysis, and then you execute with Interactive Brokers because you got a master-slave account, which Interactive Broker calls a friends and family account. Okay, so Maka, not sure if I answered your questions. I tried to compress what could be a very long conversation, but hopefully this makes sense. And I answer your question. Okay, so please let me know. Yeah, the heights. Asia is amazing. I'll just say it this way. Subhash, confirm strong 66% delta long, 33 short. Am I correct? Yes, you are correct. D-Hide, this is how the 1% got to be the 1%. I get you. Cal Gorder, to be able to cast you at a 65 TV is legit. D-Hide, and you can trade Forex in an IRA in a US if you set up your account through a third-party custodian company. You're correct. You're correct. Futures too, by the way, not only Forex, futures as well. Maka, yes, great. Maka, thank you very much. My pleasure. Orlando, thank you, Jose. Your depth of knowledge and experience is truly amazing. Thank you for all your support and guidance. Have a great week. My super pleasure, Orlando, and even a bigger pleasure, to have you guys out there, okay? Because this session would mean nothing if you guys were not here. So, again, this is a team, okay? And it's an amazing team because we all bring something amazing to the equation, okay? So I'll take your amazing, Orlando, but please, you all take my amazing as well, okay? Marcus, so in Singapore, you don't pay capital growth taxes. How about income tax? Asking because in Switzerland, capital growth is free, but if we trade regularly, we pay income tax. Yeah, not even for the, income tax, not from trading. If you have a job, yes, but not from trading. It doesn't matter if it's long-term, short-term, whatever. No income tax for capital gains. Yeah. Okay, so I have one last question from Bojan, which is STZ, isn't it? So let's take a look at STZ. Okay, so we are in this trade, by the way, isn't it? We got executed on it. So let's talk about the management of this trade, and we will call it a day. Long session today, guys, okay? Long session. Okay, STZ. So it's taking a little time to load. Okay. Yeah, Ahmad, my pleasure. Here we go. So what do we have with STZ? So if I am not mistaken, I believe we got filled somewhere here. Am I correct? Let me see. 19. So 19. Oh no, actually, no, I'm confused. Sorry, we just got filled. So we just got filled, in the very latest part. Please watch and confirm that because I believe, there's many trades in my head, but if I'm not wrong, that was the case. Okay, so we just got filled more or less around this candle where I got the vertical line. Okay, so now from there, we are just waiting for the trade to happen. Okay, so we are in a strong market condition last night, correct. So we are in a strong market condition, okay, so strong climate, okay, confirm climate, I should say, using today's terminology, and therefore we are now shooting for that further away target that we set on Thursday. So the plan for managing the trade is, first of all, using your time stop, if you do use time stops, okay, which for longer term normally we don't. And from there, start planning on the trade. So we talked about damage control. I encourage you, Bojan, to watch that session on damage control, because when it gets to a certain point, you can short shares against your calls to benefit from a gamma hedge. Okay, so this is one of the actions that you can do. And then, of course, as this market starts moving our way, okay, you could define new exit points below the new UF forms that may form. Okay, like if you were trailing stop, but without using stops, because we don't use stops. Okay, so now if this market was to move against you, again, it's a bad news, but remember, stocks are fragile. There are different forces that impact stocks. You got other UFOs below. The S&P is also in certain condition that may create a bounce at some point, and therefore that stock at some point may go up. And if that's the case, you are just waiting until the expiration date, which is October 3rd, for this to happen. Could it be that it goes down and never came back? Yes. And if that's the case, again, you could set up a place on the chart, for example here, to begin a gamma hedge the way we define in the session on damage control. Therefore, basically, there is very little to be done, but be ready to enter into damage control mode in case the trade goes against you, or enter some gamma hedge a little higher, or simply just keep trailing that price until you get to the final target that was set in the trade. Okay, so there is very little to be done. In those longer term trades, we do less management compared to what you would do in a short term trade. You could apply the same rules if you wish, including the time stop, but normally, we don't with these longer term trades, because again, if you keep closing trades too quickly, then you are imbalancing your portfolio. So if you enter this trade and tomorrow you cancel it, so next thing you know, now you are in balance, and you need to keep adding trades non-stop. Okay, so you want to give time to your trades to produce whatever they have to produce. Okay, cool. So it seems I have one last trade. So Kyle Gorder, trade number one, the risk of that spread is if the price gaps across and the stop loss, correct? There is no stop loss. Okay, there is no stop loss. The maximum you can lose is what you pay for the option. So that is our defined risk. You are offsetting the risk of the portfolio by entering short trades together with the long trades. So if the market was to fall, of course, it's not going to be fun for this trade, but you know already how much you can lose. And while this trade is losing, the other ones are profiting. So is there harm having a spread wide if the premium is better? Well, Cal Gorder, I would suggest that you watch the option sessions that we have done before, because the spread of the trade has to do with the delta you need. We position the call you buy and the call you sell in places. We use strikes that are specific strikes in order to get that 30 plus delta that we always shoot for. Okay, so there are multiple conditions on how to build the spreads, and all of this is in prior recorded videos. So I would like to suggest to please go ahead and spend a little bit of time reviewing those videos. Okay, I know there are many, and precisely because there are many, there is a lot of room for improvement on your skill on how to trade, and I would want to make sure you don't miss that. Okay, instead of giving you a short answer which is incomplete now. Okay. Very good. So everyone, super pleasure. Thank you for staying with me 36 minutes extra. You guys are the best. I love your passion, guys. We have the same, and that makes this session fun. So keep up the good work. See you in the following days for short-term trading. Take care. Enjoy the rest of the weekend. Bye-bye, my friends. Bye-bye.